Frank and Linda were 63, $187,000 left on their mortgage, 11 years remaining, retirement in 2 years. Their financial advisor said, keep the mortgage. Their gut said, pay it off. Their neighbor said, downsize. Their brother-in-law said, reverse mortgage. 4 different answers from 4 different people, all of them partially right, and none of them right for Frank and Linda specifically, because the mortgage decision after 60 depends entirely on factors that generic advice never addresses. In this video, I'm going to show you 4 options, what each one actually means in real numbers, and the specific factors that determine which one is right for your situation. Not a generic answer, a framework for finding your answer. Stay with me. Before I show you the 4 options, I need to explain why the mortgage decision changes fundamentally after 60, in a way that most financial content never addresses. During working years, the mortgage decision is primarily mathematical. Compare your mortgage rate to investment returns. If investments return more than your mortgage costs, keep the mortgage. Invest the difference. This logic works when income is flexible, when you can absorb risk, when a market downturn doesn't force you to sell. After 63, things change. Income becomes fixed or near fixed. The time horizon for investment recovery shortens, and the psychological weight of a mortgage payment on a retirement income becomes a real quality of life factor that mathematics alone doesn't capture. Here's the twist: the mathematically optimal answer and the right answer for a specific person are sometimes different things. A retired couple who sleeps soundly with no mortgage payment may make better financial decisions overall than a couple who maximizes mathematical returns but carries anxiety about their housing security. Both factors are real. Both deserve consideration. Now the 4 options. Option 1, pay off the mortgage before retirement. Eliminates the largest fixed monthly obligation. Reduces required retirement income significantly. Provides housing security regardless of market conditions. The trade-off: uses cash or investments that could otherwise compound. Best for people with sufficient retirement savings beyond the payoff amount. People who value certainty over optimization. People with high mortgage rates. Option 2, keep the mortgage. Invest the difference. Mathematically favored when mortgage rate is low, and expected investment returns exceed that rate. Maintains liquidity. Keeps assets invested. The trade-off: requires market returns to cooperate. Sequence of returns risk in early retirement. Monthly obligation continues on fixed income. Best for people with low fixed mortgage rates. Strong risk tolerance. Sufficient income to cover payments comfortably. Option 3, downsize deliberately. Sell the current home. Buy smaller. Eliminate or dramatically reduce mortgage. Free up equity for retirement income or investment. Reduce ongoing costs, including maintenance, taxes, and insurance. The trade-off: emotional cost of leaving a family home. Transaction costs, finding suitable housing. Best for people in homes larger than needed. People in high-cost areas. People whose current home costs exceed retirement income capacity. Option 4, reverse mortgage. Available to homeowners 62 and older. Allows borrowing against home equity without monthly payments. Loan is repaid when home is sold or owner moves or dies. The trade-off: reduces inheritance. Fees can be significant. Requires staying in the home as primary residence. Best for people who are equity rich and cash poor. People who want to stay in their home. People with limited other retirement income. Here's the most important twist. Frank and Linda ran the numbers on all 4 options. They chose to pay off the mortgage 2 years before retirement, using savings they had earmarked for that purpose. Their monthly retirement income need dropped by $1,140s. That reduction changed their entire retirement picture. From tight to comfortable. The math said, keep the mortgage. Their specific situation said, pay it off. Both were right, for different people. The question that determines everything. The right mortgage decision after 60 comes down to 4 questions. What will my retirement income be without the mortgage payment? What will it be with it? Does the difference create financial stress or genuine hardship? And what is my honest risk tolerance for keeping debt in retirement? The answers to these 4 questions tell you more than any generic recommendation ever could. Here's the most important twist. Frank and Linda's neighbor downsized. Their brother-in-law got a reverse mortgage. Their advisor kept his mortgage. All 3 made the right decision for their specific situation. There is no universally correct answer, only the answer that fits. Your income, your risk tolerance, your housing needs, your peace of mind. Frank and Linda had 4 different answers from 4 different people. The right answer was none of them, and all of them, depending on the situation. This video just opened a window for you. You've seen the 4 options, the real trade-offs, and the questions that lead to your answer. What you do with that window is completely yours, because everyone's situation is different. One question before you go. Have you thought specifically about your mortgage in the context of your retirement income? Drop it in the comments. Next week, student loan debt at 60. A crisis affecting far more retirees than most people realize. And what actually works when you're still paying? Decades after graduation. Subscribe. Hit the bell. See you next week. Educational content only, not financial advice. Always consult a qualified financial advisor.